Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks mostly shaking off tariff threats after Trump extends the deadline and keeps communication open with trading partners. He remains optimistic about tariff revenue rolling in August 1st.
Tariffs, as you know, are starting to come in at record levels. Tremendous amounts of money are coming in to our country. We never did that before. We're not used to it. We only have tariffs going out. We only adhere to the rules of other nations who charge us tremendous tariffs. The big money will start coming in on August 1st. I think it was made clear today by the letters that were sent out yesterday and today.
And joining us now, we've got Paul LaMonica, senior market analysis writer at Barron's, Washington correspondent Ben Worstrel, and senior reporter Ali Canal, who are breaking down the headlines throughout the show. Ben, let's start with you. What is the latest from D.C., Ben?
Yeah, we got a lot of, it's another day, another series of kind of dizzying series of tariff headlines from your three quick ones to kind of kick things off today. The first one is the question of deals. That's been the big question we've been waiting for all week. India and the European Union are in focus, and Trump at that cabinet meeting from the clip you played suggested that things were going okay with Europe, but that they could be in line for a letter too, which would be a surprise to negotiators there who have been aiming for a deal there, which would lower rates and would be a more market-friendly response. It kind of goes to this overall point of how this new deadline, which Trump referenced there of August 1st for tariffs to actually begin, is shifting the sort of the overall deadlines here for tariffs later in the month. So we still may see deals this week, but the overall deadline is shifting. And a couple other quick ones is news on sector tariffs. This is a whole nother track of Trump's tariff agenda that wasn't supposed to be in new focus this week. But we have news, which is a 50% tariff on copper. Trump announced that as well at the cabinet meeting. He talked about how an ongoing investigation of copper is ending, and then there's going to be a 50% tariff. This would join the 50% tariffs already in place on steel and aluminum. He also referenced pharmaceutical tariffs, which are scheduled to come soon. We don't have details there, but he did reference a possibility of a 200% tariff. That would be after a long lead-in period of 18 months, but that's a pretty eye-popping number for pharmaceutical companies. And then the third is another headline that would be a big story on any other day, which is new tensions with China. China offered a new warning. Trump shot back about a new 10% tariff that would be on top of there. As you noted, markets are mixed, so people are trying to digest this, but a lot of insight into Trump's tariff agenda, at least for right now.
All right, a lot of headlines there. And Ben, sticking with comments from President Trump today, he did once again call for the Fed Chair Powell to step down.
He should resign immediately. We should get somebody in there that's going to lower interest rates.
Do you want congressional
Why don't
Republicans
you call for his resignation?
Do you want congressional Republicans to investigate and pursue
Okay
and
with
punish?
me. I think he's terrible. I think, look, we're paying, I call him too late. T-O-O, too late. Like Too Tall Jones for the Dallas Cowboys, right? Too late.
So, Ben, listen, I think Trump has made his views on Jay Powell fairly clear at this point, but what do you make of those comments?
Yeah, for sure. We as you mentioned, we've heard Trump criticize Jay Powell more times than we can count at this point, and this is about the second time at least he's called for him to resign. The issue here is some comments Powell made at a congressional hearing about renovations at the Fed that some lawmakers are claiming he overstated. And the little bits of news we got from Trump today on this was that he is open to an investigation of Powell by Congress. This was kind of at the prompting of the reporter. There was another moment that I think was notable where Trump was sort of doing his overall message on Powell lowering rates, which is his clear overall issues. And he looked across the table and said, "I like you better." And of course, the Treasury Secretary, Scott Bessent, traditionally sits across the table. So it seemed to be a reference to the idea that Bessent could be a nominee still to replace Powell either this fall or next year.
Paul, I want to bring you in here as well, get your thoughts. Trump speaking for a while today, Paul. I think we were nearly 2 hours there, making a lot of news, tariff news, his thoughts there on Jay Powell. Give us your take.
Yeah, well, first off, sadly, no one's ever going to call me Paul Too Tall LaMonica. But I think that the president clearly is still banging this drum, wanting the Fed to cut rates now, and that's not going to happen. We know that at the July meeting, the Fed is very likely to stand pat. Maybe Powell tees up hints at a rate cut at the Jackson Hole speech he'll give in August, and then they'll cut rates in September. But I think right now, the market isn't really focused that much on whether or not interest rates are too high. They're concerned about tariffs, and I think that's why we've had a little bit of a pullback. There was that hope that after the post-Liberation Day sell-off and the walking back of a lot of tariffs, everyone started talking about the taco trade. I think we all know what that acronym stands for by now, but maybe Trump feels emboldened and doesn't want to be showing that he might in fact be the proverbial chicken when it comes to trade talks and tariffs, and he's talking tough again, and I don't think Wall Street is particularly keen on that right now.
And Ali, over to you in terms of how the street is reacting. What are we seeing in the markets?
Well, if we take a look on a sector basis, Ben was just talking about those 50% copper tariffs. Now, we don't know exactly when that's going to be implemented, but you can see this spike that we saw in copper futures. We're up well over 10%. We still are hovering around those 10% gains, although we are well off some of the highs that we saw earlier. And this, of course, will join those steel and aluminum tariffs. Ben also talked about the pharmaceutical possibility that we could see tariffs there. Now, we have pharma stocks in the green, but you'll see Pfizer, for example. We saw a bit of a dip here when Trump made those announcements. We have recovered somewhat. We are still up over 1%. Same with a company like Amgen. You'll see a very similar trajectory where we saw shares dip a little bit and then recover. So perhaps this taco trade at work. Trump always chickens out. But if we go back to the general markets, you're going to see a mixed picture. The Dow is leading the declines there, down about 0.3%. We have the NASDAQ and the S&P essentially flat. So the focus here is on those trade and tariff headlines. And I also think heading into the summer, we're going to see a bigger emphasis placed on earnings. There is a low bar for these earnings. So if companies can beat, if they can raise, if they can establish some firm guidance here, I think that's going to be a catalyst for stocks. And then over the past day or two, we've saw some analysts come out and raise their respective price targets for the S&P 500. Goldman Sachs is pointing to 6,600 by year end. Bank of America is more conservative at 6,300. And if we take a look at where the S&P 500 is currently trading, there's not that much upside there for that 6,300 call. So perhaps we'll see how these trade developments shake out. But I do think we are poised for some volatility this summer, especially with Jackson Hole in August, always seeming to rile markets up a bit, Josh.
All right, Ali, Ben, thank you both so much. For more on the latest market moves, let's welcome in now Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Michael, it is great to see you, sir, as always. Let's start off maybe bigger picture, Michael. You know, you look at this market, big move off that April low. Impressive, the mood and the speed of it, Michael. Where do you stand on this market here? When you're talking to clients, are you telling them, listen, we're going to move still higher?
Well, I think over time, over the next 12 months, I think we could see the market still go up another 6 to 8%. I think it's important to recognize or acknowledge that the last 3 months moves was largely pricing out of macro risk. Whether you look at PEs, which have rebounded, or credit spreads, which have compressed, it's been a very macro-led tape, where kind of a rising tide has lifted all boats. Going forward, we should not extrapolate this or expect, the same level of returns, of course, every 3 months. And we'll probably see earnings matter a lot more for stocks than macro in the coming months.
What about the Trump tariffs, Michael? We were just talking about that. Trump speaking for a while today, I think nearly 2 hours, making more news on tariffs. We had some market pros and strategists on the show this week, Michael, and they looked at those headlines, and honestly, they kind of said, you know what, you got to take a deep breath. I mean, literally take a deep breath and just realize that, in their words, it's just a Trump tactic. It's a Trump negotiating strategy. Do you agree with that, Michael, or is that maybe too complacent?
Well, I think you have to somewhat agree with that because that's been the recent pattern. I don't think we're going back anywhere near levels we saw earlier this year. The market's already been shocked by tariffs. I'm not surprised we're obviously still debating it because it's still very much a real issue. I just think it's more of a risk to the downside for specific companies or specific industries rather than systemically a downside risk to the economy or markets.
And Paul, I'll bring you in here as well. Is that how you're kind of seeing it?
Yeah, I think that right now there are definite concerns about how rapid this rebound has been from those post-Liberation Day lows. I mean, valuations, you blinked and you missed when stocks were maybe not cheap, but a little bit more attractive. Now multiples have crept back up to the 22, 23 times S&P 500 earnings estimates for this year. Maybe not overly frothy, but definitely still more risk, I think, to the downside. And as Ali alluded to, earnings are going to be coming up very soon. A lot of the big banks reporting next week. I think investors really want to hear what those companies, what the Jamie Dimons of the world have to say about the backdrop right now, whether they're still nervous, if they think that consumer spending is going to hold up, will business spending be resilient also? And if so, what is that going to mean for corporate profit growth?
And Michael, following on Paul's comments about earnings, I'm just curious, listen, Q2 earnings on deck. What are you listening for, Michael? And is it possible this is a positive catalyst for the market?
Yeah, it could be. There's still going to be a lot of uncertainty. I mean, everyone from investors to the Fed to companies are going to continue to have to react to the tariff policy changes. There's not a great amount of conviction in the economic outlook, partially because of that, and I think partially because there's some parts of the economy and some companies that are not doing well, and on the other side, there's definitely some positive and strong parts of the economy and in companies. So it really becomes again an idiosyncratic stock pickers market, I think, from here. Assuming that we don't see any interest rate shock, we don't see unemployment go up. If you look at unemployment, it's been more or less sideways for the last year, and we don't see aggressively higher tariffs, broadly speaking, which I don't think we're going to see.
What about, Michael, the bond market? Relatively calm. I'm looking at your benchmark 10-year at 4.4. Where do you see that headed near to intermediate term?
Yeah. Well, I think realized bond volatility has just collapsed. And we've been stuck in this really narrow range. And it seems like every few weeks, investors are either worried about growth slowing or inflation picking up, depending on where yields are. So I more or less think interest rates are going to be stuck or are stuck in a range here. If I had to pick, I would say I'm a little more biased to the downside, but I don't think we're going to see rates sharply move higher and be a risk to the equity market. I don't think the economy is going to sharply decline or rise or see unemployment rise. That's going to bring rates materially lower. So I think we're kind of stuck here in this range for quite some time.
And final question, Michael. You did hear Trump today going after Jay Powell again, right? He's saying again, emphasizing they're wrong. They should be cutting. Is Trump right?
Is he right? Well, you can't talk about how great the economy is and at the same time talk about cutting rates dramatically. I think importantly for investors, Powell has been very, consistent and clear. And, I think ultimately I believe he'll cut in September. He's continued to point to the dot plots and spoke about, two rate cuts this year. And I think he'll have, assuming he wants to do that, and I think he will, I think the data will allow him to do it, and he'll frame it in a way that is conducive to doing so.
Michael, always great to have you on the show. Thank you for your time.
Okay, thanks.
We are just getting started here on Market Domination. Coming up, Tesla bulls demanding action to refocus Elon Musk's attention on the EV company. We're going to discuss the path ahead for Tesla on the other side. Plus, Boeing reporting its highest quarterly delivery since 2023. Breaking down some of today's top trending tickers. That's later in the hour. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around. Much more Market Domination still to come. Tesla bulls demanding action to refocus Elon Musk's attention to the EV company. Wedbush's Dan Ives calling it a tipping point in the Tesla story. And Yahoo Finance's Pras Subramanian joins us now to discuss. Pras, so here, Dan Ives of Wedbush, of course, bull of bulls on Tesla. I mean, guy's been on this show many times. He pounds the table for Tesla. Goes on X, and here's what he says Tesla's board should do, Pras. He says, new pay package getting Musk to 25% voting control. He says guardrails establishing amount of time Musk spends at Tesla, right? I don't know. When I think of Musk, I don't think of the word guardrails, but okay, Dan. Third, oversight on political endeavors. Okay, it's an ask. Ives post this on X. Elon Musk himself responds, "Shut up, Dan." That's his. What do you make of it?
First of all, for Dan Ives, not the first time he's asked the board to step in and kind of rein in Musk. I think that's been something that a lot of people asked for. He's the second time he's asked for it now. America Party was, I guess, too far for him in terms of all the problems with government regulation. If you kind of bring that on, but be that as it may, I mean, it's just funny the whole back and forth. Ives and Musk is a big fan of Ives and vice versa. To see them kind of actually butting heads is.
To your point, maybe as you were saying off camera, we should construe it as somewhat must be maybe in his own way polite. I mean, it could have been a lot worse than "shut up, comma Dan" was your point.
Right. Just lay off right now. Right. So I don't want this heat right now. But we've been talking about this. Paul and I are talking about this. But it's like the company. It's not just Musk. It's other issues that are going on with the company for a number of months now. Demand issues. Tesla's EV tax credits threatened. Robotaxis happening now, but are they going to really sort of push the kind of the boundaries and kind of take on Waymo? I mean, we'll see, right?
Well, but it was interesting, Paul, because I think, listen, he goes on X, and Musk is now talking all about, I'm going to start this new American political party. And of course, if you're a Tesla investor, you're looking at it, you're wondering, well, hold on a second. Where exactly is this guy's focus? Where is his attention?
Yeah, and this has been a knock on Musk for years, because clearly this is someone who, for better or for worse, is easily distracted. He has SpaceX, he has X, which I still call Twitter, and many other ventures beyond Tesla. And Tesla is at a point now where they arguably need Musk more than ever, given the concerns about demand for electric vehicles and Tesla's electric vehicles in particular. Musk is now a very polarizing figure. You would think that starting a political party is not the best way to sell more electrical vehicles and eventually wind up with more contracts with NASA and other government agencies as well. So I understand Dan Ives' frustration. One thing that I always found interesting about Ives, who has remained a very unrelenting bull about Tesla, at what point do you just throw up your hands and say, I can't do this anymore? We need, if not a grown-up in the room, at least someone who's going to take things more seriously. And it doesn't appear that Musk at this point yet feels that there's any crisis at Tesla. And it may not be a crisis, but it does need his, more attention, I think, from him.
We've heard in other reporting, I think the Journal talking about the board, it was sort of weighing how they can actually rein Musk in, bring him back to work, things like that, make him sort of absolve some of these political statements. But clearly it's not working, and this is sort of maybe a failure of the board, I'm not sure, but we know that they are thinking about it. They're curious, how can they control him? Because seemingly he's got an ADD type of personality, and he can just sort of focus on different things. And the bad things are when he focuses on things that are unrelated to his businesses, and that's the problem, right?
You cut through the headlines, I mean, at the end of the day, listen, this company, it has to move cars, right? I mean, it comes down to the EV sales. That's still what's driving the company's P&L.
Right.
You looked at the recent deliveries, and they were better than at least maybe some feared on the street, and you did see the stock pop there. So now we wait for the earnings. What's ahead for that EV business?
So two things, right? I think the big thing is, when are we going to see that cheap EV that they've been talking about for over a year now, and what people think will actually be the main driver of potential new sales, right? Because right now, I think Tesla's poised to have a second year in a row of sales that are less than the year before, which is a huge problem for a company with 70x forward earnings, right? So that's one thing. And then obviously the robotaxi test. What's going on there? The whole bet of the company is on AI and autonomy, and it's happening now. It's sort of slow, some hiccups here and there. Can we hear more about more cars on the road, more users, can they open it up to test to you and I? That's the big question.
Do you think, Paul, I mean, one question would be with that EV business is the extent there's been any brand damage, and whether you think there's been any kind of permanent brand damage. Because that was another big question, whether Musk goes hip to hip with Trump, and we had any number of analysts come on the show who cover the company and say they thought that was doing some damage to some number of EV buyers, Tesla buyers, right, big fans. But now, of course, he's distanced himself from Trump, so he's also angered MAGA. Where is the brand here?
Yeah, I think it's very difficult, and it just shows the miscalculation, I think, on the part of Trump to get overly political in the first place. There's a reason why it isn't great for our business as journalists to have many CEOs come on and be very boring and cut and dry and not share any sort of views beyond what the latest quarter's earnings look like. Give Musk credit for not being one of those CEOs.
Right.
But this was a company that, remember, it used to be that like Tesla drivers, it was the liberal elite on the coast. The Larry Davids of the world were the ones driving Teslas.
Yeah.
Then it became something that maybe wasn't the MAGA car of choice, but Musk became a MAGA person, and he fully embraced it for maybe a little bit longer than Scaramucci did, but not much. And now here we are. He's probably alienating the MAGA fans because now he's very vocally anti-Trump. You just have to not talk politics if you're a smart CEO, unless you want to be one day. And by the way, he can't run for president unless you change the Constitution.
That's correct. The next guy we have to get on the show is Larry David. That's what Paul is thinking. How does he feel about it? Exactly. Perfect. Cross, thank you, my friend. Now time for some of today's trending tickers. We'll keep an eye on Boeing, Robinhood, and Datadog. Let's start with Boeing, which is reporting the highest quarterly delivery since 2023, with 150 airplanes over the second quarter, 60 planes last month alone. CEO Kelly Ortberg says the company needs to hit further production targets to end Boeing's cash burns and turn around the airplane manufacturer. Paul, what do you make of those headlines?
Yeah, I think it's encouraging to see Boeing have this increase in production. It's one of the main things that Kelly Ortberg was tasked with. It's been almost a year now that he's been on the job. Unfortunately for the company, you had another tragic crash involving a Boeing plane, an Air India plane, and that is something that the company now has to deal with as well. And until these safety issues are fully resolved at Boeing, I think it's going to be a continued drag on the stock, even if the production numbers are encouraging.
Yeah, we know Boeing has lagged its rival Airbus in sales and deliveries. Per Bloomberg, though, the June surge does put Boeing neck and neck with its competitor there. Is Boeing a buy here, Paul? Most analysts cover it, say yes. It got nearly 70% like it on the street still.
Yeah, I mean, I think Boeing stock probably has the worst priced in at this point, but it is such a volatile business. And when you are subject to headlines like plane crashes that are, I wouldn't say out of your control, because if you have better safeguards where you're building planes that aren't going to crash as much as the Boeing planes have, then that is something that I think investors are clearly worried about and cognizant of, and it's one of Ortberg's biggest challenges, I think.
All right, moving on. Let's get Robinhood as well, because that's in the news. The Bank of Lithuania announced it is awaiting clarifications surrounding the financial service company's tokenized stocks of OpenAI and SpaceX, two companies not listed on the stock exchange, of course. CEO Vlad Tenev, and speaking to CNBC, said that the stock tokens are not equity in the company, but are, quote, enabled by Robinhood's ownership stake in a special purpose vehicle. The new Robinhood tokenized stocks allow investors to expose themselves to U.S. stocks, which include private companies. And Tenev says that the construction of the tokens will withstand regulatory scrutiny. This was an interesting one. So basically, Vlad saying the company is in talks with regulators over its offerings of these tokenized equities in Europe, Paul. Tenev telling media they have some questions. He says he's referring to the Bank of Lithuania, which oversees Robinhood's activities in the EU, says they want to make sure that everything is proper. We are confident, he says. Who knows? Maybe you get tokenized equities coming soon to the U.S. Who knows, Paul?
Yeah.
From Robinhood.
Yeah, I mean, the bigger issue might not be just the regulators. It's also, Josh, the fact that OpenAI came out and vocally said,
correct,
we do not endorse this. This is not something that we have any involvement in whatsoever. So OpenAI, a still private company, may or may not go public at some point. These tokens may be something that investors are clamoring for, but if companies don't want to associate themselves with it, then that could be a problem for Robinhood going forward. SpaceX hasn't really said much, I believe, yet.
It is, what's interesting, Paul, is how, here in the U.S. we have regulators, and they've had these rules on the books for a long time that tell Paul and Josh what private companies you can get into, who can get into them. There are rules about that. I'm not suggesting that these companies are finding a way around that, because it makes it sound like they're doing something duplicitous. I'm not saying that, but it is certainly setting up this really interesting kind of alternative to that. Yeah. So we'll watch and see. Finally, Datadog falling at a rating downgrade that came from neutral, price target introduction of 105 by Guggenheim. So this one, Guggenheim does this, they cut this one to sell, Paul. They say OpenAI, its largest customer, may have already started to move off Datadog for log management onto its internally built solution. They say it could mean revenue risk in the second half. Their target is 105 here.
Yeah, I think that there are legitimate concerns that OpenAI may be looking to adopt more of its own in-house technology, which could be a negative for Datadog. Datadog, obviously, though, a very diversified company. They're not entirely dependent on OpenAI for revenue. And remember, this is a company that just got added or is about to be added to the S&P 500 index, replacing Juniper Networks. A lot of people thought Robinhood would get that slot. Robinhood's still waiting. Datadog is it.
This does look like the only sell on the street here. Most actually still like Datadog. Of course, doesn't mean Guggenheim is wrong. Will it be a good buy or good buy for your portfolio? We're taking a close look at two stocks that may have surprising impacts. Stick around. Much more market domination. That's coming up next. Welcome to Goodbye or Goodbye. Our goal here, helping you cut through the noise to navigate the best moves for your money. I'm here with Hennessy Energy Transition Fund Portfolio Manager. That would be Ben Cook. Ben, welcome to the show. Let's get you going here with your buy, but we're going to start there. Now, this is named Expand Energy. It's up about 7% this year, Ben. I will say most of the analysts on the street, Ben, about 90% who cover this name, they tell their clients it's a buy. You get actually zero sells, so you're in good company. Let's run through the list of reasons, Ben, you say it is a smart place to commit capital. The first reason, geographically advantaged. Walk us through what you mean by that.
Yeah, thanks for having me, Josh. We believe that Expand Energy has an advantaged set of assets located primarily in Northwest Louisiana. That's in close proximity to where we see much of the growth in LNG export capacity over the next several years. They'll benefit from higher production as well as better pricing because of that asset footprint.
All right, and second reason, benefiting from lower leverage.
Yeah, Expand was formed last year with the merger between Chesapeake Energy and Southwestern Energy, and since that time they've done a good job at reducing their leverage. They're now embarking on a production growth phase where they're able to, because of that lower leverage, spend more money, and that's going to benefit them longer term.
Final reason you say this one's a buy, Ben, significant free cash generation.
Yeah, the company's articulated a cash return profile to investors that's extremely attractive to us. They pay a base dividend, they're going to be paying down debt, and they're going to be paying a variable dividend and repurchasing shares as well.
So now you made a good case, Ben, but before folks all pile in, right, we want to remind people, what are some downside risks you think they need to consider?
Yeah, we see some significant tailwinds to natural gas demand growth over the next several years. If there's any kind of change to that picture, that could pose a risk to Expand Energy. Part of that would be a change to the LNG export outlook here from the United States, or any kind of deviation from the strong trend we're seeing from AI power demand for natural gas.
All right, so that's your buy. Let's move on to a name you would avoid, Ben. That would be Occidental Petroleum. This one is down about 10% year to date. It's still one to avoid. Go through the reasons there. One, crude oil production waiting challenge.
Yeah, as the market might well knows, this is a company that's grown through merger and has grown its oil production by the acquisition of Anadarko Petroleum in 2019, and again, Crown Rock last year. Company's weighting towards oil production is roughly 52%, which is higher than its peers, and we think that could create some headwinds given the headwinds to oil prices here over the next 6 months.
Second reason, significant leverage weighting.
Yeah, as I mentioned, the acquisitions that the company has undertaken over the last several years has resulted in above average leverage. And as a result, they're required to, really the market wants to see them pay down that debt before they start returning significant cash levels to investors.
And third and final reason you say this one to avoid, Berkshire Hathaway's large stake.
Yeah, the name Berkshire Hathaway is generally associated with a bullish outlook on the stock. Berkshire owns roughly 28% of the common shares, and they own a significant preferential issue as well. Obviously, a succession issue at Berkshire Hathaway, Greg Abel coming in from for Warren Buffett's seat. Any kind of communication that would suggest less interest in the equity, we think would be create an overhang on Occidental stock.
All right, now before you avoid it though, what would be the upside risk you got to think about?
Yeah, great question. Obviously, any move that would support a higher move to the crude oil price would be beneficial for Occidental. So we'll be watching for any kind of change in crude fundamentals over the next 6 months.
All right, so there is a buy, expand energy, avoid Occidental Petroleum. Ben, great to see you. Thank you, sir.
Thank you very much.
All right, thank you for watching. Goodbye, goodbye. Stick around, much more market domination. That's right on the other side. Amazon's Prime Day deals will take front and center stage for most shoppers this week as it extends its signature shopping period to 4 days for the first time. But this year, as in recent years, it is not alone. Yahoo Finance's Brooke DePalma joins us now with more. Brooke.
Good afternoon to you both. Certainly what we've seen in recent years is really Amazon get taken on by their retail rivals. Think Target, think Walmart specifically, but so many others are looking to get on this big splash of savings like Target, Home Depot, Lowe's, Best Buy, even Tractor Supply and Ulta Beauty. Well, they're looking to get in on the action too. But let's take a closer look at one of their biggest competitors, Walmart. Well, Walmart, they're really up their ante when it comes to their e-commerce business. In the last quarter, that e-commerce business here in the U.S. just turned profitable, and now they're really doubling down on their offering this week. They're, instead of just having a 4-day event like Amazon Prime, they're looking to do it bigger. And so Walmart's having a 6-day event from July 8th to July 13th. That's trumping Amazon Prime's Day event from July 8th to July 11th. Now, some sources telling me that Amazon is clearly the big winner this week. And sure, customers, just top of mind, they'll go to Amazon first, they'll look at the prices, but then ultimately what they might be doing is going elsewhere in this environment where consumers are so conscientious about how much things cost. They really are conscious about where exactly they want to spend here. And so they'll go elsewhere. They'll go to that Walmart. They'll go to these other retailers. But this could be a prime opportunity for Walmart. That's what some analysts tell me. Specifically, what they really want to gain here is memberships. Walmart Deals Week, they're ultimately enticing those Walmart Plus customers, something that'll launch back in 2020, to sign up. They're saying, hey, through mid-July, we're going to offer 50% off, and that could be a big opportunity for Walmart. But when you really look at another business that Walmart's winning on, that's Walmart grocery business here. Of course, they've been touting that in recent earnings call. They're gaining more high-income shoppers, and that Walmart Plus membership also tends to be higher income as well. But when you take a look at the numbers, guys, Walmart's e-commerce business is far, far lower than Amazon's business here when it comes to just how much money they're bringing in. If you take a look at last year right here, you can see that Walmart brought in around $121 billion when it comes to their e-commerce business. That's, of course, far lower than Amazon's e-commerce business, online stores. And also, when you think about just how much membership fees they bring in, Amazon also surpasses by a landslide how much Walmart Plus brings in when it comes to membership fees. And also, the top side here is that Walmart Plus subscription is far lower than Amazon Prime. Also, they're offering that half off right now. And so it could entice customers. That's ultimately what Walmart wants here. They want to take the eyes away from Amazon.
Would there be certain categories, Brooke, where Walmart would think, okay, we have maybe some type of competitive advantage here? Would be, for example, would it be food sales?
Yeah. Certainly. So 60% of Walmart's U.S. sales is grocery, and that's what ultimately Amazon has to worry about here. One analyst telling me that one of the biggest things that Amazon, or rather Walmart, has to look out for is if Amazon gets competitive on their grocery business. And what we've seen in recent months is really Amazon invest, look around, see exactly how they could really integrate and grow that Whole Foods acquisition that happened back in 2017, just a few years ago now, it seems like, with the pandemic. But really, they're trying to entice consumers here with that.
So it's interesting, Paul. I was reading this note from Evercore's Mark Mahaney, who we both know. And Mark's one of those analysts, smart guy, been around a long time. And when Mark speaks, people tend to pay attention. And he was saying his own surveys, though, show, even as we talk about this competition, Mahaney was saying his surveys show that, listen, Amazon is still running point here. They are the clear leader, he says, in online retail, the clear leader in just price and selection and convenience.
Yeah, I think that many curious shoppers are going to look around and maybe try and find bargains, but how many are there that aren't already Prime subscribers? And if you've got that
gets
Prime
sticky,
subscription, it's incredibly sticky, not the least of which you need to watch it to, you need it for watching Yankees games now on Wednesdays.
It seems like everything now is tied to some sort of subscription.
There is some subscription model, Prime Video, very, very sticky. And I think that consumers probably aren't as interested in having multiple e-commerce. I'd be curious if there are surveys about that. We all know that they've got Disney Plus, they've got Netflix, they've got Prime Video, but are you also going to be one of those people that has a Prime subscription for retail, for shopping, but then also
a bundling.
Walmart Plus?
Right.
Yeah.
I don't know if there's that overlap necessarily.
Yeah. And Walmart Plus is really the free pharmaceutical delivery right now. They have a Paramount Plus subscription within that $90 per year bundle. And so it's like this bundle where it's like, how much can I squeeze into this membership that really makes it worth paying that annual fee for? And when you think about it being a little less than Amazon, of course, they raised their prices over the recent years. It's like, what is going to get them there? Once again, that grocery business, the free grocery delivery, something that Amazon has struggled to really retain consumers with, that's something that could give Walmart an edge up here. Of course, they're way behind still.
I think there's only so low that Amazon is willing to cut prices at Whole Foods. That's clearly still a brand with a higher end sort of consumer. So they may have to concede defeat, and Walmart's going to win that one, I think.
Do we know, Brooke, the Walmart Plus membership, do we have any kind of line of sight into what's the demo for that?
Yeah, it typically skews middle to higher income. Think about someone who's paying $98 a year. Of course, now Walmart likes to entice consumers, and they offer certain incentives for, say, consumers or customers who are on SNAP benefits, also customers who maybe come in a certain income level. And so they'll offer, say, this deal throughout the year, but specifically now that 50% off. But of course, even at 50% off, that's still roughly, say, $40-ish per year. And so it's not necessarily cheap, but they're saying, hey, we're going to give you all these bundled in. That makes the price tag worth it.
I did see reports that Amazon's Prime Day sales fell about almost 14% in the first 4 hours of the event compared with the start of last year's sale. But as you said, Brooke, it's 4 days now, so let's see how it shakes out.
Well, it's 4 days, not 6 days like Walmart, but also think about all these companies also doing deals. And in this environment, if they're cross-comparing and they're trying to get the best deal, did it actually work? Did some other retailers take share from Amazon? I think we'll have to figure that out over the next few days.
We'll have you back to break it down. Thank you,
Sounds like a
Brooke.
plan.
Appreciate it. Now let's get to our call of the day here. HSBC coming out with a call on big banks downgrading Bank of America, JP Morgan, and Goldman Sachs. Joining us now is the author behind that very note. That would be Saul Martinez, head of U.S. Financial Research at HSBC. Saul, it's great to see you. So if you just look at a chart here, I'm just looking at the XLF, nice move off the April low. And I guess, Saul, when I was reading through that note, that was sort of the issue here in part. It sounds like you were telling your clients, Saul, listen, the fundamentals look healthy, but valuations may be a bit stretched.
Yeah, I think I would agree with that. We're not adopting a more negative view of operating fundamentals. We still think that net interest income is on the right track. You are seeing some growth there. The regulatory environment has improved, and that it manifests itself in more buybacks. Credit seems okay, but the universal banks, so the money centers and Goldman, Morgan Stanley, they are up over 30% in the last 3 months. And really the negative or the more cautious stance on those stocks really do reflect valuations. They are trading the JPM, BAC, Citi, Wells, Goldman, Morgan Stanley. They are trading at hefty premiums to their own history. And they're no longer trading at sizable or historically elevated discounts to the S&P 500 anymore. So you've seen a very big move. By contrast, super regionals, which we still like, still are trading at more discounted multiples. But, I mentioned operating fundamentals being okay, but there are risks in any scenario, in any market environment. There are risks to the downside, and macro uncertainties are still elevated, and a slowing economy would mean rates moving lower by perhaps a greater than anticipated level. We have 3 cuts in our forecast. The forward curve is still close to 5. So the universal banks are more sensitive to net interest income. So in an environment where you slow down, there is some adverse impact, and that does not seem to be priced in very much. And then the third thing is that I would just mention in terms of being a little bit more cautious here is that, yes, the deregulation story is good. The recent stress tests were phenomenal. And we are incorporating more buybacks into our forecast, but we're incorporating more buybacks at 30–40% higher stock prices. So that's very dilutive to book value per share, to tangible book value per share. And in fact, when I look at my share count estimates today versus back in April, after forecasting, putting into our models much more in buybacks, share count still moved that much. Why? Because even though in dollar terms they're buying back more stock in our numbers, they're doing it at a much higher price. So that offsets it considerably. So that is, all of those things are kind of factoring in. And obviously there's some nuances to each of the downgrades of JP Morgan, Goldman to reduce, and Bank of America to hold. But at a high level, it's valuation, pricing is not factoring in downside risk, and the dilutive impact of buybacks at much higher multiples are all sort of considerations we're factoring into our views.
Let's dig into a couple of specific names, Saul, because you do take JP Morgan and Goldman. You took both of those to reduce rating. Just walk me through those two names in particular.
Yeah, I mean, look, I've always been a little bit hesitant to put reduce or sell ratings on companies that are great companies, and they are great companies. And there are a lot of things to like about both of these companies. That said, there is a price for everything. And in JP Morgan's case, I think the math just doesn't work at these valuations. The stock, so with banks, you look at price to tangible book value multiples and return on tangible common equity, higher ROTCE, higher price to tangible. JP Morgan is trading close to 3 times tangible. That is a very elevated multiple. So the problem is, part of the story is you're buying back a lot of stock, they have a lot of excess capital, but you're doing it at really high multiples, which is very dilutive to tangible book value per share. So we only forecast 1% to 2% tangible book value per share growth in 26 and 27. So if you take a step back and you say, okay, how can JP Morgan be a compounder? Can the stock appreciate 10+% annually? Well, what you're assuming is that price to tangible book value multiple will continue to rise. The only way you justify that is returns on tangible common equity continuing to rise from levels that are already high. So you go to 20+%, which is already above what they think sort of a through the cycle ROTCE is, and it just continually moves higher and higher to justify a continued appreciation. So the math is very, very difficult to work here. And our target price gives us about 12% downside. It's a similar case at Goldman. And again, we feel like we're swimming against the tide with Goldman a little bit because the investment banking landscape is good. They've done a really good job of improving revenue quality. But in that case, with Goldman, we ran upside and downside case scenarios. We ran an upside case scenario. IB fees get to 2021 level, which is we're exceptional. We have optimistic assumptions for asset and wealth management. We still only come up with a $707 fair value in that estimate. Stock's trading pretty much at those levels. So in a downside case, which is not a really negative downside case, it's a mild downside case. We get a $500 fair value. So that's about 30% downside. So the risk reward is very skewed here. We think good news is priced in, but again, if the market cools off, and IB activity doesn't really move forward, we don't get a super cycle in IB activity, I think there's more room for disappointment here than for upside.
So that's what you don't like, Saul. Let's end here on what you do like, because I know you told your clients you do see opportunity in the regionals. How come, Saul, and what's a name or two you like there?
Yeah, look, I think when you look at the regional banks, they have, they've underperformed the big banks, but they've performed okay over the last month or a few months, but you still have had underperformance for a number of reasons here. And when I look at valuations, they are still below their 10-year average. They're still at 45 to 50% discounts. And when I say super regionals, I'm talking about U.S. Bancorp, PNC, and Truist. We have buy ratings on all of those. Those are the largest regional banks in the U.S. And I do think that a lot of the things we're optimistic about for the universal banks also apply to them. Their balance sheets are repricing to higher rates. So net interest income has gone from contracting in 2024 to growing this year. You have positive operating leverage there. You have capital being built up. You're starting to see in some cases a bit of loan growth. So I do like US Bancorp a bit. I do think it's a differentiated business model, not just commercial banking, but they have a good consumer banking business, a leading trust business. They're generating positive operating leverage. They're trading at roughly 10 times 2026 earnings. So it is discounted, amongst the highest profitability of any bank we cover. And we also like Truist, which is a little bit more of a turnaround story, but we think they're making progress on costs. We think they have a strong capital base, and again, it's at 10 times earnings, and we think the ROTC is moving from low double digits to mid-teens, and we think there's room for multiple expansion there.
So always good to see you, and we appreciate your time and those picks, sir.
All right, sounds good. Anytime.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.